Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your co-host, Joel Elconin, along with Brianna Valesky, and we have Ian Weiner on the line, and he's Director of Equity Trading for Wedbush Securities. Ian, how you doing this morning?
I'm doing well, thank you.
So, a busy day for you. It's the end of the quarter, and we were just talking about the significance of, end of the quarter and window dressing. Is there unusual activity on this day? Give us your take on the end of the quarter.
Well, I think yesterday was the mark, as we like to say.
Could you explain that?
Yesterday was definitely
the mark?
People window dressing. Their bullish positions for sure. And then today, it'll be interesting to see how things shake out. You still have that motivation by investors to want to get the market up again today, but you clearly have some headwinds with the stronger dollar and with oil selling off.
Okay, yeah. So let's go to some of the macros out there, and we're past the earnings season, getting ready for the next one. We'll go to that next, but let's just talk about some of the macro factors here. Number one, I guess interest rates. I mean, Janet Yellen, it seems like she's pretty dead set on doing something in 2015. That could have an effect on the market. Give us your outlook on interest rates and what investors should be paying attention to.
Well, I think the important thing is every morning you got to get up and ask yourself, what's the second derivative of liquidity right now? And if it's increasing, then it's awfully hard to make a huge bearish case on the market, and it's awfully hard to see rates go up at all. So, when China comes out yesterday and says that, they're going to ease or they're going to do different stimulative measures, you got the ECB program in place already. You've got Japan buying everything in sight, and you have countries around the world continuing to cut their interest rates. And so all of that spells a hard decision for our Fed, right? And I agree, the Fed would love to raise rates this year. The issue they have is the dollar. And if they continue, if they do raise rates, and the dollar will probably continue to strengthen, and that is not good for the U.S. economy and not good for multinational corporations here. So they're kind of in a bit of a pickle. And as far as interest rates, even if they raise a quarter point or even if they raise a little bit, the 10-year bond, it's hard to see the 10-year bond going much higher than 2.25%. It feels like it's going to be range-bound, just because even with a quarter tick up in interest rates, the economy is not exactly going gangbusters.
And, also, if you look at, like, the economic growth, and inflation and whatnot, I mean, if they take a little bump up in interest rates and then, the weak numbers become weaker, then they're really going to be in a pickle, and they're going to have to go back to some kind of form of QE. So I think the Fed's in between a rock and a hard place.
They are going to have a difficult time, and there's no doubt. And the reality is there's no inflation anywhere. And we'll see on Friday what wage growth looks like, but that's been anemic. And so why would rates go up in an environment where price of goods and everything and all the major commodities continue to fall?
Okay, speaking of commodities, crude oil here, just consolidating, spends a little time above 50, a little time below 50. You get a lot of predictions for this to be trading in lower 30s, higher 20s. To me, it just looks like it's stuck in a trading range. What's your take on crude oil?
Yeah, I mean, it certainly seems like kind of 40, 50 is where we're going to be for a while. You have, on the one side, you have a lot of supply, right? And on the flip side, you've got, some new geopolitical concerns in the Middle East. What's interesting to me, at least, is, if I told you that Saudi Arabia was invading Yemen, that there were all kinds of issues all over the Middle East, and crude just goes down, that speaks to the amount of supply out there. And, if we actually do some deal with Iran, that's just going to continue to add to the supply. And it just seems like that direction is down.
Okay. All right. And the oil stocks up one day, down the next day. What kind of trading activity is seen in the oil stocks? Is it, are the institutional investors? Is that 3.5%, 4% dividend? Is that enough to keep them interested in your oil giants like ExxonMobil and Chevron Corporation?
Well, yes, but if most investors, I think, these stocks are sort of in no man's land. I mean, the guys who've wanted to get out, and Warren Buffett, for example, right, have gotten out, and the crew that's buying these stocks are value buyers. They're not, growth. So value buyers don't chase stocks. They'll buy Exxon when it dips, back below 84 or wherever. But so it's kind of there's no real catalyst to get them higher, and the risk is that if crude continues to go down, even the value buyers are going to step away, and then you'll see a further downside in names like ExxonMobil. I think investors, if you're looking for a dividend yield, you're going to buy Microsoft. You're going to buy something that's actively buying back stock and going to continue to buy back stock because if you add the dividend yield and what you're getting back and reduce share count, et cetera, then you're talking kind of 5%. And I think that's where people are going to go relative to an ExxonMobil, where the next step for a lot of these companies, in addition to cutting capex, and we saw, Freeport cut their dividend, and it's going to be: are we going to cut our dividend? Are we going to have to raise more money? How can we be buying back stock when we need to preserve our capital? So that's why I think that's less appealing in a name like Exxon or Chevron, and more appealing in a name like Intel and Microsoft.
Okay, and let's move on here. Another, gold that just looked like it was taking out the bottom of its trading range, battled back to 1,200, now back on. I mean, is there any reason investors should be rushing out and buying gold bars and sticking them under the mattress?
I don't think so. At least not yet. Gold typically is more appealing in a higher inflation environment. We're not seeing that. Gold is more appealing relative to a lot of bonds, just because the yield on a lot of these bonds has gone negative in Europe. So from that respect, and if you're truly worried the world is going to implode, obviously gold is where you want to be. But I don't see any sort of impetus to have to be in gold.
Okay, and we're still a little few weeks away here from earnings season, and despite earnings being pretty good for the Q4, it seems like we had a little bit of lowered guidance. And when you lower the expectations, then you don't have as high a bar to reach here. You think that's what's gonna bust us out of this trading range between in the S&Ps between 2030 and 2100? What are you looking for in earnings season?
Well, I mean, here's what we got to ask ourselves, right? We have opened up, now that the dollar's gotten this strong and crude has gone down this much, we have opened up the possibility that S&P earnings for 2015 will be below S&P earnings for 2014. If that's the case, or even if they're close, I mean, we're talking about no earnings growth. We're talking about almost no revenue growth in the S&P this year over year. So, you're going to expand the multiple again, right? Which, okay, if you want to continue to expand the multiple because there's massive liquidity everywhere and you can't own anything but stocks, then yeah, I guess that people could do that. But it's just hard for me to tell people, buy stocks because, if you're a true fundamental, analyst looking at stocks where earnings growth is, there is none, and it's actually going to decelerate potentially and go down, that's a tough environment to say go crazy buying stocks.
Okay.
So to me, I'm nervous about what's going to happen in earnings season. I think everybody thinks the bar has been reset, and everybody thinks people are going to buy stocks on that, and that's consensus. And that actually the shock trade would be they actually go down hard on reduced guidance.
Ooh, that would not be good for the market. Let's just talk about what's going on with the merger and acquisitions here. You had the Kraft Heinz deal last week, made some good money for Mr. Buffett. You have mergers in the reinsurance. You have things going on in the biotech sector. All these smaller companies getting snatched up. I mean, some people that say that would be symptomatic of a market top. What's your opinion?
Well, I mean, I don't know if it's symptomatic of a market top. I think it's symptomatic of massive liquidity being pumped in the market, right? It all comes back to that. Because if you can't earn anything on your cash that's sitting on your balance sheet, you really only have a few options. You can buy back stock, which everybody's been doing at record paces, or you can go out and buy other companies. And that to me is sort of what people are doing. They're looking at their balance sheets and saying, all right, we can buy this, we can buy that, and yeah, there's some risk, but if we're not going to earn anything on our cash and we're not plowing money into our businesses, right? There's no capital expenditure going on, so they're not hiring people. So they're going to go out and say, all right, well, if this makes sense strategically, I can do it. And guess what? 9 out of 10 times, my stock is going to go up on the acquisition because everybody's going to view it as accretive and taking out competition.
Yeah, and that back in the old days, the acquirer used to go down and worried about it, but now it seems like a lot of these stocks, they do the deal and they pop them up as well. So that's definitely a change from the trend in the past here. Just going on to some stocks, in the news, the movers. I know you have you guys on your desk, trading a bunch of different things and paying attention to the news. But yeah, your Tesla trader, he must be pulling his hair out lately. It looked like he had a technical breakdown over the last 2 days and comes, roaring back. I mean, someone has to be really nimble in that issue. What kind of advice do you give them when they're trading a stock like that with probably some institutional size?
Well, I mean, it's ultimately it's either going to be a big hit, and continue to be a big hit, or it's not, right? And it's not, even at 190, it's not priced for any issues. So to me, if you're going to trade Tesla just to trade Tesla, I get it. You can whip it around a little bit, but even so, it's going to be tough to kind of get in and out of the stock. But from an institutional perspective, there's real headwinds here. And even though Musk is hyping up the stock, and what does that tell you, right? The guy used to never say anything, and now he's tweeting every other day about different things that are coming out. So it speaks to me of a little more kind of desperation than anything else.
Okay. All right. Moving on to the social media stocks here. You had a breakout in Twitter over 50. Everyone piled in, and now it's just, hanging out here at the level. You getting a case here where the breakouts turned into a fake out?
Which one's this?
Twitter.
Yeah. I think it's a fake out. I think everybody in the street has gone from short to long. I think that the reality is, the bulls are talking about how MAUs are kind of backward looking. But at the end of the day, either these guys are accelerating their user base, or they're not. And that has cooled off, and you need to see that to get people excited. I mean, remember, this is a big company now in terms of market cap. This is not, something that, down 25, 30 was a fat pitch, but at 50, you're going to need some real institutions to come in and believe this is worth 60 or 70 to be buying it here. And, I think we'll find that out, when they report. But I actually think that this one's, going to be going lower.
Okay, Facebook raises to new all-time highs here and pull them back a bit. Any take on Facebook here?
Yeah, I think Facebook's going higher. With each of these sectors, you have to identify. Mutual funds are they're somewhat limited in their allocations within sectors. They want to buy winners. They don't want to own losers. And so Facebook, to me, is the preeminent company in the space. And they've got enough different things going on that, if you want to own a name, this is the name. Even though it's the price is, you can argue, the valuation or whatever, the price is to me not the issue. It's just a simple issue of them executing. Because if you're a mutual fund and you own Facebook, and they have a good quarter, you're not selling Facebook, to buy, something else in the space, because you want to just take, you're holding on to Facebook and you're just going to ride that. So there's no reason to get off this train until something happens, and then, then when if it does, then you get out.
Okay, and then just one other question here. I mean, you got the unemployment data coming out on Friday when the market's closed. I mean, that's a pretty unique thing happening. I mean, how do you have the boys come in on the desk anyways, or how do you handle that?
Well, a lot of my guys are Christians, so it would be tough to bring them all in on Friday. But no, I mean, at the end of the day, right, you could give me the numbers, right? And I still wouldn't know what to do with them. I mean, it's the reactions are so different. It just really depends on the day. Is a good number good because the economy's better? Is a good number bad because that means, they're not going to be, you're going to raise rates? It's hard to tell. I think the key is wage growth. Like we talked about earlier, that's what the Fed's watching. The Fed needs to see that grow to give them some impetus that to do something, because then maybe inflation's getting a little bit higher. Maybe they're starting to see some price increases, but until then, to me, it's more likely they're going to be in the dovish camp.
And just another quick question here. I mean, yeah, we're in a trading range, in a well-defined trading range, but now you're starting to see volatility within that trading range. Does that make you a little bit nervous?
It does, in the sense that it clearly shows lack of conviction on either side, right? There's no follow through up. There's the follow through down is limited, and I think it's back to the original point of you have these different forces kind of playing off each other. I think all it does is just make things harder to invest in, and it creates a situation where active managers are going to continue to have a tough time, because they're going to be getting whipped around unless they're trading pretty actively. So the advice to traders is trade. Don't get married to stuff. And the advice to investors is, look, make a decision and kind of stay there, because you can drive yourself nuts, trying to figure out, like, we're up 2%, we're down 2%, and what really is happening here.
Do you run into Mr. Pachter at all?
I do, of course.
Okay, all right. Well, if you see him, tell him that we really enjoyed having him on the show last week, and he was talking favorably about King Digital Entertainment, and that's made a stellar move. So, Tom, we really appreciate that tip, and we're looking forward to having you both back on the show. You guys give us great commentary.
Anytime.
All right. Ian Weiner, Director of Trading for Wedbush Securities, joining us.